Not too long ago, I was just like many of you, with empty pockets but a burning desire to secure my financial future. And you know what? I did it! I turned that zero into a six-figure sum through investing. The best part is, you can do it too! In today's video, I'm going to start from scratch, with absolutely $0. If you're new to investing, or you are hesitant about investing because it seems too complex, don't worry. This video is your ultimate beginner's guide. I'll break it down without any fancy financial jargon. By the end of this video, you'll know what the stock market is and how to make money from it, what to invest in, and where to buy it, so you can start your investment journey with confidence. So let's get started. What is the stock market? Well, to make this crystal clear, I've got a story for you. Imagine for a moment that I'm not your friendly host, but the owner of a successful lemonade stand company. My lemonade stand is booming, lines of thirsty customers stretching around the corner. In fact, it's doing so well that I'm thinking about expanding and opening another stand a few streets down. To do that, I need more cups, more lemons, and more sugar. In essence, I need more money. As a business owner, I have two main options to get more money. The first is heading to the bank and asking for a business loan, but I have to pay it back with interest. It's like borrowing $1,000 and returning $1,800 or more. The second option, which is where the stock market comes into play, is an IPO, an initial public offering. This is like me, as the lemonade stand owner, saying, "Hey world, I'm taking my lemonade company public." You break your company into 100 shares and offer them to anyone who wants to buy. You set the price per share, let's say $12, and on a specific date, like next Friday, you announce that anyone can buy a piece of your lemonade company. All the money from the shares sold goes directly to your company. In 2014, Alibaba did something similar. They needed money, so they went public, breaking their company into 1 million pieces and raising a whopping $25 billion. That's essentially why companies create stocks and offer them for sale to everyday people like you and me. Let's say you're a huge fan of my lemonade empire. You've seen my earnings, tasted my product, and think there's major potential. So, you decide to buy one share for $10. In return, I give you a piece of my company. Not literally, but like a virtual trading card. Once that share is in your hands, you can trade it, sell it, or hold on to it as you see fit. Your investment helps my business grow. As the lemonade company becomes even more successful, more people want to buy shares. The more demand there is, the higher the share price climbs, which means the value of the stocks you already own increases. You can now sell your share to someone else for even more than you bought it for. That's how you make a profit. But, and this is important, if for some reason my lemonade company starts to lose its appeal, maybe there's increased competition and fewer people are coming to the stand, the value of your shares can go down. In that case, if you anticipate that the stock price is going to fall, you might decide to sell quickly, hoping to make a profit while you still can. As shares are sold, demand drops, and so does the value of each share. This buying and selling of stocks, this bustling marketplace, is what we call the stock market. Imagine you own Tesla stock and want to sell it. You log into your brokerage account and it tells you the current price, say $1,000. When you hit sell, your stock enters this digital space, waiting for someone else to buy it. So let's go to, why would anyone want to buy a stock, and how do they actually make money from it? Well, there are two primary ways people can make money in the stock market. Let's break them down. First, we have capital gains. This is somewhat similar to what happens with real estate, like when you buy a house. Imagine you purchased a house for $500,000, and 10 years later, you sold it for a cool $1 million. The profit or capital gain in this case is the difference between the price you bought it for and the price you sold it for, which in this case is $500,000. The same concept applies to stocks. For example, let's say you buy a stock for a company like Amazon at $1,000 and you believe it will go up in value, say to $1,200 in the future. When you sell it at that higher price, you've made a $200 profit. That's one way you can make money in the stock market, through capital gains. The second way is through dividends. Now, not all companies do this, but some companies, kind of like saying thank you, distribute a portion of their profits to their shareholders. It's like a little gift for being part of their success story. Let's take my lemonade company, for example. If it's doing exceptionally well, and I have extra profits, I could decide to distribute some of that all to the people who hold shares in my company. These distributions can happen quarterly, annually, or at different times, depending on the company. Some companies have been doing this for decades, consistently giving back to their shareholders. So, people actively invest in stocks that provide dividends because they're essentially receiving regular income from their investments. It's worth noting, though, that companies aren't obligated to pay dividends forever. They might have been doing it for years, but circumstances can change. For instance, during the pandemic, some companies decided to stop giving dividends. That's why many investors see dividends as a nice bonus. The idea is to invest in companies that you believe will experience capital gains, the value of your shares going up, and the dividends are an extra reward. That leads us to what to invest in for now. I wanted to share a quote from Warren Buffett.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30 year period, I would pick a fund. And I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read the books, and it's all you need to know really about fund investing. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
We can take two lessons. Number one, invest in index funds, and number two, do it for the long term. We heard a lot of terms like stocks, mutual funds, index funds, and EFTs, and they can seem like a bunch of financial jargon. But don't worry, we'll break it down into simple language right here. Let's focus on index funds. We all have probably heard the phrase, don't put all your eggs in one basket. In the world of finance, think of your money as the eggs and individual companies as baskets. If we put all our money into just one company, like Coca-Cola, we're essentially placing all our eggs in that one basket. So, if Coca-Cola were to face hard times, our financial eggs could be in jeopardy. Now, an index fund is like a collection of these baskets. These baskets can be grouped in various ways, like by sector, such as tech companies, or by size, such as the biggest companies in the country. Think of an index fund as a basket filled with baskets. When we invest in an index fund, we're essentially buying a piece of all the companies within that fund. This is a brilliant way to diversify our investments. Let me explain further with examples. There's the S&P 500, which represents the 500 largest companies in the United States. If you take a look at this list, you'll recognize many names like Microsoft, Apple, Google, and more. Then there's the FTSE 100, comprising the 100 largest companies in the United Kingdom, including names like HSBC, BP, and Unilever. When you invest in an index fund, you're essentially buying a small piece of all these companies. This means you're spreading your investment across a wide range of companies, which is a smart strategy. It's not like putting all your eggs in one basket, but in many baskets. It's called diversification, and it helps manage risk. Index funds can be a great choice for long-term investing because they provide diversification and typically have lower fees compared to actively managed funds. And there you have it, your starter pack on how to get started with investing. If you found this video helpful, I've linked another one right here that you might enjoy as well. Thanks so much for watching. If you haven't already, please consider subscribing to our channel. I'll see you in the next video.